So what is, I'll explain the front end debt ratio
Okay.
first.
Hmm.
Your front end debt ratio is your mortgage, your principal, your interest, your taxes, and insurance, along with PMI if you paid mortgage insurance. It is your obligations to that house specifically, not your electric, not your cable.
Today, I'm very excited to have Nicholas with me. Nicholas is a mortgage loan originator at RCG Mortgage, where he helps guide clients through the mortgage process and secures the best loan options for his clients. With his expertise, we're going to dive deep into the ins and outs of getting a mortgage for first-time home buyers. Nicholas, thanks for joining me.
Absolutely, Mr. Hussein. It's an absolute pleasure speaking with you. Thank you for having me on today. And I've been doing this for quite a long time, 24 years to be exact.
Nice.
So I've been around the block from every aspect, through all the collapses, through pandemics, through lockdowns. So let's talk about, most importantly, what most of the clients really need to know and how they need to move forward. So it's a pleasure being here. Thank you so much for having me. And let's get into it.
Yeah, absolutely. So, today I want to talk about mortgage, and usually, I feel like 95% of the first-time home buyers, as I found out in the statistic, is that they have to go to the bank to get a loan. Only few percentage who go out there and buy house with cash money, right? And but what happens is that about 95% of these home buyers, and the first thing they think about is getting in touch with the real estate agent. But what they should do is the first thing is to get into find out what the process of buying a home is, and find out what they're approved for and whether they can buy a house or not. So real estate agent becomes the person who have to redirect them to the bank. So I wanna talk about what do the first-time home buyers need to know to get into this market, and then understand what the process is. So can you give us that process, the basic, what the first-time buyers need to know? And let's start with that.
Absolutely. You're 100% right. A lot of times they do go to real estate because they have the desire, hey, I want to go ahead and get into a house, and they want to put the cart before the horse, so to say. The first thing you really want to do is have a conversation with your loan officer, your bank, your loan originator, and they're going to want to find out certain key items for you. So as someone that needs to be prepared to have that conversation, most of it's in your head. What's your name, your address, your date of birth, your social security number. So someone that wants to pay attention, you really want to know where your scores are. As a broker, we're going to go ahead and run your credit. The bank's going to run your credit to see where you fall. So there's different credit scores. Obviously, what one person gets is different than what other people get. There are 3 credit bureaus that are out there: Experian, TransUnion, and Equifax. And as a banker, you run all 3 of them. And the banks use the middle of your 3 scores.
Now you're
So have,
scaring me. You are
what
scaring
was
me right
that?
now. You are scaring me right now. You gotta check my credit. It's gonna affect my credit.
Well, that's a common misconception. And anywhere you're going to get any type of loan, they're going to run your credit, right? You go to get a
Right.
credit card, you're going to run your credit. You're going to go get a car, they're going to run your credit. Obviously, highest credit score borrowers get a different ability. The better the credit, the better ability you have to maybe put down less money, get better interest rates. You've all seen the people that get advertised 1.9% interest rate on your car, and then they get there, it's like 14%. Well, your credit wasn't that good. So you want to know where your credit scores are. And also, one of the pieces you mentioned is, hey, you're running my credit could drive my scores down. The banks understand and the credit bureaus understand that you have to run your credit to get a pre-approval to be able to see where you stand. And they allow a certain period of time for you to actually run it multiple times.
Right.
Generally, rule of thumb is anywhere between 14 to 30 days. I'm sure you'll see other places and other people say, oh, it's even longer. Realistically, they want you to do a little shopping. They want you to get comparative rates. They want to see where you're qualified and at. So your scores really won't drive down if you're running it multiple times in a short period of time. They understand you're going to get competitive quotes. So that's one thing that other people are like, oh, you ran my credit, it dropped my scores. It really doesn't do that when you're running it for a mortgage purpose in that 1, 2, 3 times with 3 different banks in a
So
very
you're
short
kind
period
of
of time.
encouraging people not to get scared, in a sense that if you are doing within, let's say, 30 days, if you're doing multiple times, you should do it, because since you already ran the credit once, if you want to get competitive, you should do it within that certain amount of time, so that way it doesn't get affected anymore, right? Is that what the
Yes, it won't be affected in the first few weeks. After
okay,
that, it will start affecting you because
right,
what you're basically saying to the credit bureaus is I keep going for credit and nobody's extending me credit. So that's when it starts to drive things down. I ran it like this month, last month, another month. I keep running it. I got no new debts added on there. But at the same point in time, I'm not doing anything other than running your credit. So it's something you don't want to run it a lot, but it is understood and it's not going to ding your credit if you ran it a few times in those first couple of weeks for mortgage purposes.
so you were
But
saying how many weeks would you say in general purpose, like four
I
weeks?
wouldn't go over two. It
Two?
allows you to go more, but I really wouldn't want to break past that. And the truth be told is you haven't found a house yet.
Right,
So you running your credit 3 times with 3 different banks until you really find your home, until you find that and get into contract, you could be out looking for months, right?
right.
You know, how many buyers have been out for 3, 6 months looking for houses, maybe started in January, February, and well, they're still looking for homes. So did it matter what bank told you what rate 6 months ago, 8 months ago? Truthfully, no, because the rates are changing every minute of the day. You know, so at that point, you have to find someone that you're comfortable with, someone that you trust, and someone that's going to be here for the marathon. It's not a sprint. It's not
Right.
like you're buying a pair of shoes and you can return them next week. You're going to buy a house. You know, the house takes a lot of people to get in there and work with you. You got to go through the real estate agent, go see the houses on the weekends. You got to make your offers. You got to hope that everything stays in line. You know, so things do change and your credit score changes over time. Maybe you just ran up your credit and just bought a new car recently and your credit's, taking a little bit of a hit. But over the months, you've seen your credit score go back up. So that's
Right,
one thing that you really want to have prepared is an idea of where your credit is. You know, I
right,
know a lot of people go ahead and check Credit Karma. I'll tell you right now, it's not the same scores that we see. Credit Karma is not going to be the same, but it's a great guideline. It's something
mhm,
that you can go ahead and look at and have a gauge for where your scores are, but not to be specific. Another thing you want to have prepared is knowing your income. Are you a W-2 employee? Are you a 1099 employee? Are you a business owner? So those documents, your tax returns, your W-2s are going to be important. Then that's something that a loan officer is going to need. They're going to check your finances. It's not the day of going ahead and saying, hey, I make this much money and well, that's good enough for us. No, we're going to need to prove exactly what you said. I make this much money. I work as a W-2 employee. Well, I'm going to need 30 days of pay stubs. I'm going to need 2 years of W-2s. You know, they want to know housing history. Are you paying rent? Are you living in a home without any rent? So these are some things that we're going to need to understand and know how much money do you have saved. You know, at the end of the day, your down payment's going to play into the rate as well, along with your closing cost. How much money do you really have to go and buy a house? You know, that's something that's important, always for someone. You can't buy $1 million house if you don't have a penny, to scrape together.
right.
You know, but there are different programs out there and different styles, but we can get further into that. But the most important things is your income, your assets, how much you have saved, and your credit. Those
So
three things
those
are
are
really
three
going to
things
be
you were talking about. Basically, the credit, income, and if you have any
an assets.
assets. Okay. What about the debt? How does the
Well,
debt?
that's all going to play into it, your income. So
Okay.
debt to income ratios.
Okay.
So there's different types of programs out there, and I can go down a list of millions, but what most people understand is your conventional rate mortgages. That's your Fannie Mae and Freddie Mac loans. And
Right.
then they
Yeah,
understand
absolutely.
FHA.
Those the Freddie Mac and Fannie Mae and then FHA loan and BA loan. We could definitely get into that aspect of it. But so as for them, they come to you. You tell them that these are the things we need. They provide the documents. So what are the, let's say also if you are not W-2, if you are a cash earner or if you are a business owner, how do they prove those things, and what are the exact documents do you look for in that respect? Yeah.
Okay, so if they're not a W-2 employee and they run their own business, they're business owners. That means most likely they're filing their tax returns as a business owner and they file personal tax returns. Some businesses go ahead and they pay themselves as an employee, as a compensation to officer, and they'll pay themselves 80,000 and the business is making certain amount of money. So in those scenarios for those business owners, we need to see your tax returns, business and personal, because just because you paid yourself $1 million on the books doesn't mean that your business is profitable, right? You could be in the red and you could be paying something. So we're going to be looking at the last 2 years, full tax returns, business and personal, to see what your nets were. Because it's one thing to make $1 million in your business. You can go down to your retail store. I'm sure they sold $1 million worth of items, but at the end of the day, it costs them a certain amount of money to buy those $1 million of items to sell. So maybe it cost them $700,000, and now they sold $1 million. Well, that's $300,000 in profit, but then they had rent, electricity, they had to pay employees, they had to, do other things. So what is your net profit?
Okay.
Now, in the banking department, we have items that can be added back in there, so it's not a complete deduction. Depreciation can be added back as income, but I'm not going to get into the nitty gritty of every finance of what they look at. But that is one possibility for your business owners. Now, there's also some business owners out there that go ahead and they really don't show a lot of money. They don't declare a lot of money, or they wrote off a lot of money last year. Well, there's another program out there that you can do business bank statements. They'll take your last 24 months of bank statements from your deposits, and they'll average those out over the 2 years and then take a calculation based upon that and another calculation off of it. And that's another availability for the business owners, because it's what showed to the IRS, what you deposit sometimes is two different things in that aspect. And it's every business owner has deductions out there. And maybe it's just this year you had way more than you needed. Maybe you bought a brand new car and you depreciated it in your business. You bought 5 new vans. So your business didn't show that much profit, but at the end of the day, you were bringing in money. And the bank will be okay with that. Your conventional loans, they go up to around 49.9% debt ratios, and that's a front end back end debt ratio combination. Your FHA loans have a front end of 46.
Can you talk about the debt ratio? There are a lot of people who don't understand what does that mean, 49% and back end and front end. Can you give a little more? Yeah.
So I'll explain the front end debt ratio first. Your front end debt ratio is your mortgage, your principal, your interest, your taxes, and insurance, along with PMI if you paid mortgage insurance. It is your obligations to that house specifically, not your electric, not your cable. It's just your principal, interest, taxes, insurance, mortgage insurance. Let's say it's $4,000 a month. Well, that's going to make up your front end debt ratio. Then, so you have your front end debt ratio is called 30%. You made a good amount of money. Then you have credit card debt. You have student loans. You have car payments. All the things that report on your credit report. Well, that is going to add to your front, and they'll make a back end debt ratio. So your mortgage payment on the house is $4,000, but you have a $550 car payment. You got $300 in student loans. You have $250 in minimum payments on your credit cards, and then you add all that up with your front, and that's going to make the back end debt ratio. So your front and back are different. Your front is focused only on the mortgage, the house itself, and the back compiles all the mortgage and everything that reports on credit to give you a combined front to back debt ratio. In the conventional world, they'll allow you to go to 49.9% front and back, straightforward. In the FHA world, they'll stop you at 46 on your front end debt ratio, 46.9 to be exact, and then they'll allow you to go all the way to 56.9 on the back end debt ratio. So it's a little bit more restrictive on the house side, but it allows more on the back end side for those credit card debts and cars and student loan debts. So there is a breaking point where conventional stops at 49.9, but FHA can go a little bit further. If you couldn't pay off that car or if you couldn't get your debts down lower, it's a better suited.
So FHA has more flexibility of you having extra debt on your portfolio. Is that?
They have more flexibility up for the back end, but not the front end. If you realize they limit you to 46.9, well, conventional allows you to go to 49.9 on the front.
Right. Most of the time, people's mortgage is one part of their debt, that monthly cost. But
that's the front.
Yeah, and that's the front. And most of the time, the other debts like car payment, student loan, that can become a very gigantic in the back end. And in that sense,
absolutely could.
And the FHA could be a very better help, right?
FHA could be better help for those high credit card, high student loans, high car payment people, where you'd fail conventionally at 49.9, you get the extra 6.9 or 7%.
So now that we're talking about the different types of loan, FHA and conventional, and then I'm sure there are others. So why don't you break it down? What's the benefits of conventional and FHA, and what are the down payments that each come with?
Well, there's a common misconception about FHA loans being worse than conventional loans. It truly comes down to the client. It's not always, well, FHA allows you to go with lower credit scores. They
Mm-hmm.
can go as low as a 580 credit score,
Okay.
even a little bit lower with certain banks with a manual underwrite, extenuating circumstances. But for the guidelines that we're speaking, 580 credit score, FHA. Meanwhile, a conventional, even at 620 or 640, while you may pass, it may not behoove you because the interest rate will be so much higher. It's like just passing in school. You know, if you went to, to be a doctor and everything else and you got like a 70, there's a good chance you're not going to be the best brain surgeon. You're not going to be working on people's hearts.
Yeah.
And I'm not to say knocking doctors, but you just passed. You really didn't put it in. You might become a doctor somewhere, but not the best of the best. That's similar with a conventional loan. You got a 620, 640 credit score. You're really not the best of the best, but you passed. You're in there, you qualify, but they're going to hit you out. The bank will hit you for having that low score. So your interest rate will be higher. You're more of a risk to them. Well, FHA would allow you to have very similar scores at 580 or pricing at 580, 600, 620, 640, 700. The rates stay very similar. So in a lot of cases, it's not about what fits everyone best. It's about what fits you best. What is the
So
criteria
you
for
are
you?
saying FHA, if you are having if you are in a different score, it's not going to affect your it's not going to affect your interest rate?
Not as much.
Okay.
So not as much. Very small, maybe an eighth of a percentage point here and there.
Okay.
Meanwhile, the difference on a conventional could be a point and a half
Oh, wow.
with low credit scores.
Mm-hmm.
Yeah, I can look at clients and said, hey, they want to go conventional. Yeah, the seller doesn't want to sell it. They have, peeling paint, and that's where FHA really comes in play. Sellers have bad misconceptions about FHA. They're worse loans. They're not as qualified. Well, this is Federal Housing Administration. They're just as qualified as anyone else. Actually, they're more strict with their income. They don't allow to go to 49.9% front end debt ratio.
What is the negative aspect of having a FHA loan?
The negative aspect for a seller of having an FHA loan
No, for
is
buyer. I mean, seller
there's
is,
not a negative
I
aspect.
shouldn't care because why would
It's not a
seller?
negative aspect. It's a loan.
Right.
If your monthly payment is less, if I went to you and said, okay, you got this beautiful rate, but your payment is $100 more expensive, or I got this ugly rate and your payment's $100 cheaper, doesn't it matter what your payment is, not what your interest rate is?
Mm-hmm.
So there are occurrences where FHA will beat out a conventional mortgage because the person's scores are just here and they want them here conventionally, and the payment saves $200-300 a month going FHA. Where the pitfall becomes is one, the sellers have misconceptions of FHA loans, and the FHA appraisal is a little bit stricter than a conventional appraisal. They will not allow you to purchase the house as is in an FHA loan. What's that mean? Straightforward. Well, we're not allowing peeling paint. A home buyer in an FHA mortgage cannot walk in a house and have peeling paint off the ceilings and everything else. That needs to be fixed. Every stairwell needs a hand railing, safety. They don't want people falling down the stairs and going that way. Siding, everything needs to be in order. It doesn't have to be pretty. It just has to be in place. You can't have siding falling off the house where a conventional is, oh, I'm buying the house as is. I understand that there's a missing this. I understand there's peeling paint. I understand the siding's falling off. And I'm willing, as a conventional buyer, I'm willing to look past that because I want to buy the house. Well, FHA is going to say, sorry, go fix those items before we let you buy the house. So sellers themselves try to avoid it because they may know something is wrong with their home, that when an inspector comes there and then it won't pass appraisal, and now they have to fix their house before the buyer goes ahead and buys it.
Got it. Yeah,
so that's where the fear of the FHA loan comes in.
Right. So it's a huge benefit for the first-time home buyer because this is the only, I mean, FHA is offered to only first-time home buyer, right?
No, FHA, you cannot have two FHA mortgages simultaneously.
Okay.
So An FHA does not allow for investment properties. So
Mhm.
you can't go and buy a second home investment with an FHA loan. You can buy a second home if you had an FHA loan. You could buy an investment with a conventional loan, but you can't buy it that way. So FHA allows you pretty much only to have one home at a time because you're going to go ahead and you can't buy it as an investment. So it was done as an owner occupied.
So how can you buy another let's say I have a FHA home right now, right? And then if I want to buy, if I want to move to another property, which is another location, and then is going to be my primary house, can I apply for FHA loan?
You can absolutely apply, but your house will need to be sold prior.
Oh, really? So I cannot leave the other house as my property, or I
You
could refinance that one as if I want to keep it, right?
you could do a couple of different things with it. So how far away are you moving? Are you moving over 100 miles?
Yeah, I'm
Um,
giving a scenario. Yeah.
so that's going to be a very onesie twosie situation.
Hmm.
So I have an FHA mortgage right now, and I want to move 100 and something miles away, and I'm moving out, and my job just changed.
Hmm.
You're going to have to, at that point in time, rent out your place. But that if you have the FHA mortgage still there, you can't do a second FHA. But
Okay.
you can go ahead and do a conventional mortgage and do it as a home owner occupied home because you obviously are moving out of that house. And
Right.
you could show some rent on the FHA. You just can't have two FHA mortgages at the same time. So if you needed to, and you couldn't afford it, obviously you need to sell your house that's FHA and then go and buy the other one. You could do it as a simultaneous close. So you could go into contract and you could close your house in the morning and then buy your new house in the afternoon because it'll show satisfied.
Hmm.
So you could do that in that aspect, but the FHA won't allow you to have two mortgages simultaneously.
Got it. So let's talk about the mortgages that come below. Like, do we have to pay 20% mortgage, or we can do
Down payment.
down payment? Yeah.
So back in early 2000s, the age old adage was I got to save 20%.
Right.
20% is the down payment. Truthfully, even then, you didn't need 20%. What the 20% rule comes into play is for the conventional product, Fannie Mae, Freddie Mac. And once you put down 20%, you avoid what's called private mortgage insurance.
Right.
If you put down anything less than 20%, you'll be charged a premium, a percentage, from 80 to 84.99, from 85 to 89.99, from 90 to 94.99, from 95 to 97. Each one of them, as you go up the levels, will go ahead and change the premium charge, the rate they're going to charge you. And what is PMI? It's private mortgage insurance. It protects not you, but the bank, because the bank is protected up to 80% on what they lend. After that, they need their own insurance to protect them in case you fail. So obviously, less money you put down, the higher risk you are for failure, right? Someone that puts down zero money on a house is a lot higher risk of walking away from that house than someone that put down 20%. So they charge you private mortgage insurance. And that's why the 20% thought process has stayed there. I don't want to pay PMI. What's PMI? Most people don't even know what the percentage is. And with someone with a great credit score and maybe an 85%, 84.9% borrowed, that they might be paying, 0.15 difference
Hmm.
to do that payment. But as you go higher the PMI goes with you. So that's something to keep in mind. Now, that is totally different than FHA. FHA force places. Now, it's not called private mortgage insurance. They have their own wording, but everyone intertwines them together anyway. It's
Right.
called MI, mortgage insurance.
Hmm.
So with an FHA loan, if you put down less than 10%, so 90 and above borrowed, the FHA mortgage insurance will stay there for the life of the loan. That's forever. So straight up, as long as you keep that mortgage, if you don't refinance or sell it, the mortgage insurance will be there every single month for the next 360 months, which is 30 years. With 10% or more down, the borrowed, you're going to disappear after 11 years FHA with a mortgage insurance. So
Okay.
that will be changed there. Now, in a conventional product, jumping back, let's say you borrowed 95%, right? Conventionally, where in FHA, that will stay there forever. In a conventional world, it will go away when you naturally get down to 78%. So what's that mean? Let's say I bought a $100,000 house. I put down $5,000, 95. I borrowed 95% conventionally. As soon as your payment goes down to 78,000 owed on that house, congratulations, your mortgage insurance will naturally fall off. If the values of your homes continue to rise in the next 3 to 5 years, and now it's worth 130, 140,000 for that $100,000 house, well, congratulations. You can go ahead and show the new value to your home, supply it to the bank, and they'll make sure it goes away. The PMI will go away. But you can't do that with an FHA loan. The only way to get rid of it is to go ahead and refinance the property or sell it. Get rid of the mortgage itself.
So FHA loan, you cannot get rid of the MI, right? Mortgage insurance.
It's a time frame. It's not a balance amount. If you borrowed above 90 or above, it's there forever. If you below 90, it will disappear in 11 years, which is 132 months.
The only way if you borrowed, if you paid down payment, let's say more than 10%, but less than 20, then you could get rid of it 11 years, no less.
11 years naturally goes away, FHA. On your 132nd month of paying, you'll go away.
Okay, and if you are paying down payment less than 10%, then it never goes away. So you're paying life of the loan.
Life of the loan.
Right.
Or refinance or sell.
So you could only do that with a refinance. Yeah, it's a lot of money, but it's a decision that one has to make, whether they're gonna refinance or not. That comes with the cost, right?
It does, and you got to remember one thing. Someone that's doing the professional job is running every single scenario like this out. Right. What rate do you have conventionally? What would fit you here? Well, the rate would be higher here, but we got a lower rate FHA. Well, the mortgage insurance will be this for how long? So this is all the mathematics that have to go behind it so that when someone sits there and has a conversation with you, I can say, Mr. Hossein, congratulations, this is the best loan for you. Based upon my scenarios, I ran it conventional, I ran it FHA, I ran it with 5% down, I ran it with 10% down. I ran it with all the criteria you provided me, and based upon the current scenario, this loan fits you best and why. Here's your monthly payment change, your mortgage insurance here, but you put down this, it'll disappear naturally here. So that's where it really has to play out, and someone that you're talking to has to be a professional. Because I've had a lot of people say, I don't want an FHA loan. I'm like, I'm saving you $300 a month. This is why. So I'm saving you over the next 30 years, even with the way the mortgage insurance is, you're going to save $108,000. Do you really want the conventional loan because Bob, this builder, doesn't want to sell it to you with it as an FHA loan? Like, you're going to pay up for that house. So our job is to make sure the mathematics
like that. Are they allowed to discriminate in that sense?
There's a lot of discrimination because not discrimination by people or human or color or creed or religion.
So in that
based
sense,
upon the FHA approval.
Can they
it's
say
an FHA mortgage because they still have that old mentality. FHA is worse. FHA is a worse product. They're not going to get approved. I'll kick it back to the person. What's wrong with your house?
But
what are you afraid of?
Do the seller have a said to that? Like, oh, I don't want the buyer who has FHA loan.
Yeah, sellers have told agents that. I don't want it. And here's why.
Can they explicitly say it in a sense that in a legal purpose? Are they allowed?
Legality? Technically, if they know something's wrong with their house.
Okay.
Right? Let's say I have peeling paint. Let's say I have X, Y, and Z wrong with my home. I don't have the money to go ahead and sell it. I don't have the money to go ahead, not to sell it, but to fix it. Mm-hmm. And I'm not going to go do all that work. Maybe I'm an older gentleman. Maybe I'm a young, older woman, and I'm in my 80s. I don't have the energy or the people that I can go ahead and that can help me to do this, and I don't have the money anymore to go fix it. Right. So I say this cannot go that way. This has to be sold as a conventional loan as is, because I am not fixing up this house so that it would pass that FHA appraisal. So in that scenario, yeah, someone could say that.
Oh, yeah. I mean, those are the struggle a buyer will have to come across once they're in the market. So we talked about the process of mortgage, that you must get a pre-approval if you want to go find a property. And to do the pre-approval, you have to have certain documents to provide about your income, your credit, and your asset. And then you go search a house, you find the house, then they come and decide on what type of loan they want, and you as a loan originator, you help them find out what best, right? What would be because just because they have pre-approval doesn't mean that they have a loan. That just means that they have the capacity of getting that amount, but now you have to figure out which loan will best be for their need, and then you guide them with a FHA or conventional, or the rate or the down payment they have. Um,
I'm
and
going to stop you there.
Yeah.
A little bit of what you said, yes, but the pre-approval has all that. We've already figured out which way they're going. When
Mhm.
someone's pre-approved, we are running every scenario right then and there to figure out what they qualify for. Now, obviously, as
So
time
you already
passes,
deciding by then if they're gonna take a
when
FHA.
they're pre-approved with an FHA or conventional approval right then
Okay,
and there. It's
got
just
it.
finding the bank and finding the specific rate. And here's the part. Every house isn't cookie cutter. So you can't say everything is the same.
Mhm.
So if I gave you a pre-approval, Mr. Hussein, let's pretend this out for a second. I gave you a pre-approval for 700,000. I said the property taxes cannot exceed $10,000 a month, right? Well, what happens if you found that house and it's on the water? Is it the same pre-approval? Probably not, because you're going to have flood insurance. You're going to have
Yeah,
probably higher taxes.
right.
So it's like a balancing act. It's like a seesaw when we were children, because every single house you look at, anyone could go to their neighbor, look at one house, same house next door, paying higher property taxes, paying higher homeowners insurance, right?
Mhm.
It's not every house is cookie cutter, so it's not the same pre-approval. We're trying to give you a baseline. We're trying to give you a really good wide net so that you can go out there and see homes.
Got
But
it.
at points in time, one house, I can get you qualified for an extra $100,000 if the property taxes are just, $600 cheaper than the other house.
Mhm.
We're in New York, right? That's where we predominantly do a lot of our business. You come to Long Island, and you can go to one town that the average property taxes are $35,000 a year. You can go to another town where the average property taxes are $12,000 a year. Well, that's a difference of $24,000. That's $2,000 a month. A house at 800,000 in one town versus the other town, is it the same pre-approval? Absolutely not. Their payment is $2,000 more expensive in that town. So it's being able to make sure they understand the guidelines. What is the baseline we're sitting at?
So
At the
now
end of
that
the
you
day,
you you really brought a very uh, important about the pre-approval. Now, let's say someone is approved for $800,000 in Queens. Doesn't necessarily mean they can go and buy a $800,000 house in Long Island.
well, if the taxes are the same, but generally in Queens, your property taxes run maybe $6,000 to $8,000 yearly. And if you just take that little bit of a jump over the border and go to Valley Stream, the average property tax in Valley Stream are about 15, 16,000.
Right,
Right there, you're talking about almost $800 monthly change.
right,
So in that borrowing power, if you were maxed out at 800,000 and you wanted that house that had 16, 17,000 in property taxes, you just lost maybe 125,000 in borrowing power. Your $800,000 pre-approval just became 675,000
right,
because the property taxes. Think about again a seesaw. If property taxes are higher, the value's got to come lower. If we have a middle section that is a monthly payment, we can't exceed. So
right,
no matter, and so it's a very big balancing act, and that's one thing where people say, "Oh, how good's long a pre-approval for? How good is it? It's good for some people will say, oh, it's good for 90 days. Well, what happens if the rates just went up? Is it still good? Yes, a pre-approval is good when rates keep dropping, but if we have days like we maybe had last week where interest rates jumped over 3/8 of a percentage point in 24 hours, if someone was maxed out and they were at their limit at that 49.92 debt ratio and every single penny counted, guess what? They no longer qualify. The interest rate that someone was using was low and now we're higher.
right,
So as rates rise, you need to have a direct conversation with your mortgage broker, the person that gave you that pre-approval, before you go out and see any home. You should be reaching out to the person that gave you that pre-approval and saying, hey, Nick, Jim, Bob, Mary, whatever name you want to use, am I still good? I want to go see this house at 123 Main Street. I know that the rates made some changes. Can you rerun this scenario to see if I still qualify so that I'm not going and wasting my time or my real estate agent's time looking at a house that I no longer qualify for? And that was the pains a lot of people went through from 2021 up until, well, let's just call it till like about a month ago.
Mhm.
Every time they got a pre-approval, if the rates rose, they were scurrying and chasing their feet because they were looking at houses that they no longer qualified. Remember, we went from rates that were in the average of mid threes all the way up to hitting a peak around 8.25. So that's a big change, almost double 2.5 times the interest rate. Obviously, the monthly payments changed along with that.
Right. So, I mean, those are very important, very good information. Thank you for providing them. So now, I want to talk about a little bit about choosing the right lender. Because I personally had a very tough time when I bought my first house, and it was I had no clue because I was like a first time buyer, had absolutely have no idea what the whole process is, and didn't have much of a network to find out how the process works. So I went and got a pre-approval with Wells Fargo, and then I was looking for a house, and the agent whatever. So it was a different agent, and we finally got into a contract. And now the whoever pre-approved me is missing. It's not there. I couldn't get hold of the person, and then um, I was like, they gave me three months contract time to get a mortgage. So almost like I went to Citibank. Citibank gave me like I don't know. This guy was another scam artist where he was constantly asking me this, that, and then I never got that conditional approval. So for two months passed by, and I was kind of panicking. And then finally I was able to get mortgage from the Chase. And I went there, and they went and they gave me the conditional approval on the day that I went there, and it was a much smoother process, and I was able to close on time. So that was a very rough time for me, and I felt like as a first time buyer is very important. Like being able to be in touch with a good um, mortgage person who would be able to take you to the finish line. So what would you say about what is the red flag, and what can a first time buyer should avoid when it comes to finding the right lender?
I think you just got to find someone you truly trust and that works with you. Yeah. There are many, many quality banks and lenders. For the most part, they're all very quality banks. But it's the individual, it's the person you're speaking with. We've all had amazing experiences at places, and we've also had very horrible experiences at places. Have you ever went out to a restaurant and the food was fantastic, everything was amazing, and the waiter just wasn't good? Or wasn't attentive, wasn't there for your needs. And yeah, you still bought the food, you still sat down in there, and you still didn't walk away. But through this process, you need someone that you can communicate with,
Mhm.
someone that's going to be an advocate for you, someone that's going to answer the questions and take the time to explain it to you. If the answer is because I said so, like when our parents told us to, get out of the room, or why? Because I said so back in the day. That's not the answer. Why is this happening? Why did you choose this loan over that loan? What's the process going to be? I tell every one of my clients, this is not a sprint. This is a marathon. We're going to be in here for the long haul. Especially in the New York area, we have long contracts. These are 2 months, 3 months on or about dates. And then we have 30 days after that by law. In other states, contract date is the contract date. You're closing specifically on that date. Well, we have too much gray area in New York to allow us to go further. So the process takes a lot longer in New York. On average, you're talking about 60 to 120 days from contract start to close. So during that time, what is your communication with the person? What's changed in your life? What's happening with your credit? Did your credit expire? Did you need to extend your locks? Are you able to communicate with the person? And most importantly, are you able to find the answers out when you're going to look for the house? Because if I can't reach my loan officer and I was out looking on a Saturday afternoon and I want to place an offer on this house and, well, the payment's a little bit higher, the house is a little more expensive, but the property taxes are a little lower. Do I really qualify still? What happened over the week? You need to have that conversation to ease your mind. And if you can't reach them until Monday, guess what? Especially in a seller's market, you might have lost your house.
Yeah.
So it's really communication, and it's how you are being spoken with and how much someone has the best interest. Now, here's the reality. We're not always going to tell you what you want to hear. We're not here to, as loan officers, as bankers, we're not here to tell you, oh, it's pretty, it's all roses and sunshine. We're like a doctor. We're telling you the problems. We see that there may be an issue. Hey, does that house have a certificate of occupancy issue? Does that house have all the permits? We're not here to try and scare you away, but we want to find out because there's different criteria. Different banks allow different things where other banks would deny it. So are we putting you in the right position? And for most brokers out there, they deal with a plethora of lenders. So I can't fit, maybe I don't fit the Lamborghini mold, but I do fit the Ferrari. Maybe I fit the Toyota. It's what fits you best. That's why there's so many banks. It's not cookie cutter with the banks either. Each bank has different products that they are allowed. It's like going into any store. If you went ahead down the block and you needed to go buy dinner tonight, are you going to get it all at the neighborhood convenience store, or are you going to have to go to Stop and Shop or BJ's or Costco or somewhere else? Brokers are pretty much like the Amazon of the internet of the world. We find it out there because we deal with all the banks. So
Great.
the answer is,
Yeah, that's awesome. Now, what is the rate right now? Was
right now, or 5 seconds ago, as it was going up.
Yeah, what is the rate?
The reality is interest rates are like a stock. They trade every single minute that the markets are open. They're going up and down. Currently, the rates are rising.
Yeah.
And that's very a common misconception of what people think is happening. I believe it was only a couple weeks ago that the Federal Reserve spoke, right?
Yeah.
Right.
So,
It was the first time the Federal Reserve lowered the rates in 3 years plus, maybe.
Yeah, I mean,
It's
it's 2 years since they started raising. Now, this is the first time they started bringing it down after 3 years, I think. Yeah.
Yeah. So actually, that had the opposite effect of what everyone believes. And I'm going to touch on it real here. Everyone believes the Federal Reserve, when they lower and raise the interest rates, are raising the mortgage rates. It's not. It's an indicator of what will happen with interest rates, possibly. But the Federal Reserve does not control the mortgage interest rate. They control the home equity line of credit. They control your CD rates. And they control your credit card interest rates. They control your auto loan interest rates. They control your savings rates. They do not control the mortgage rates. So a lot of people have been on the edge. Oh, the Federal Reserve lowered the basis 50 basis points. If you go back to the day that the Federal Reserve did that, the actual rates for mortgages went up. And actually, they've been steadily rising since. And that's very weird to say, but the rates in the past 2 weeks have went up over half a percentage point, the exact amount that the Federal Reserve lowered the rates by. But I heard that the Fed lowered it. Yeah, they lowered other possible rates. They're not controlling it. Now, they're an indicator of what's out there. But for the most part, the 10-year Treasury helps give the best idea of where the rates are moving. And if you watch a 10-year Treasury, I think if you turn on TV right now, it's trading at 4.01 to be exact at this moment in time. And that's considerably up from where it was about 2 weeks ago before the Fed spoke. Jobs reports, inflationary reports, PPI, which is your product pricing index, CPI, which is your consumer pricing index. All of these help lead to where the economy is going and what's going to happen with interest rates. It's not the Fed.
Yeah, I mean, isn't it like, well, maybe 25 basis point or 50 basis point, it doesn't help right away, but maybe once they bring it down, let's say 100 basis point or 200 basis point, it starts showing some kind of
showing to what part of the market. So I'm actually going to almost disagree with where you are. The Fed lowering down the rates. Let me give you an example, if you don't mind. I'm going to date us back to November of 2023. Was one of the highest interest rates we've possibly seen over the past 3.5 years. The interest rates hit on a conventional level right around 8.25%. From November, December, January, February, March, April, May, June, July, and August of all that time, the Federal Reserve did absolutely nothing to the rates, right?
Yeah.
We just established the Federal Reserve for the first time in the middle of September lowered the interest rate for the benchmark rate. Well, how then did the interest rates go from 8.25% down to 6.25% if the Federal Reserve did nothing? That's a 2 percentage point difference.
I
That
guess
means
that's the thing. I think it plays with the inflation. Inflation came down, so the Federal Reserve.
that's right.
Right.
The Fed, what they do is when inflation is high, they raise the interest rates of our borrowing, your credit cards, your car loans, and all that. The reason why they do that is to curb spending. They want to stop spending because the more you spend, the higher inflation goes. So one of the Fed's tricks is to try and raise the rates, and that will curb spending. Well, unfortunately, we've spent a lot. And another thing they try to do is they want to see job reports. The more jobs that are created, the more jobs that we have, the more money's flowing into our economy, the more spending will be, right? So if we have more jobs, we're spending more. That's going to hurt inflation. That is why on Friday, that this just past week, I think it was October 4th, the jobs report came out. If you go and look at the estimated amount of jobs reports on Friday, I think it was 124,000 jobs was supposed to be estimated to be added, and I think the final number was we added 250 to 260. That means the estimates were off by double. Instantaneously, we understand inflation is going to go up. More people, more jobs out there, more money flowing. Inflation is going to do the opposite of what they've been trying to do. And what exactly happened on Friday is interest rates in the matter of one day went up 1/4 percentage point. Yes, 1/4 percentage point in the matter, it all was pretty much in a matter of 6 hours. So someone speaking to someone on Friday morning would have had a 25%, 0.25% lower rate than talking to someone on Friday afternoon.
So
That's how fast rates change.
it's more sensitive toward inflation than the Fed rate.
It's completely inflation and what's going on with our economy, not what the Fed does.
It's also a long-term borrowing because you are kind of locking it for 30 years. So if inflation is not under control, then the bank is kind of losing money by letting you borrow that much money for that long. You know what I mean? So
yes,
that's the reason, one of the reasons that.
Mr. Hossein, one thing that people have to keep in mind, and it's very short-sighted. Everyone remembers the last 13 years. Everyone remembers the interest rates back to 2020, 2010, 2011, when interest rates got into the 4s and 3s.
Yeah,
what they tend to forget is that they forget the interest rates before that. They forget before the largest financial collapse in history, where almost 50% of banks went under, where some of the biggest institutions failed. That is why interest rates got as low as they were, and honestly, they were asleep at the wheel for too many years. Rates should have been higher. Prior to 2009, there was never an interest rate in history that was in the 4s, ever. You go back to the 80s, the average interest rates were running in the 15, 16% range. But nobody wants to look that far back. If you did a 50-year running average right now, of the last 50 years, with 13 of them being the lowest interest rates in history, as low as 2.875 in some cases, you still have an average rate over the past 50 years at around 7.4. 7.4 average rate. So right now, interest rates at 6.25 are considerably below average. So a healthy economy is in the mid-6s, right? Because that means inflation's not out of control, but everyone just remembers the short term. Oh, they were so low, we're going back to there. I don't see it.
Yeah, I mean, we don't want to, as a human being, once we get access to something that is so easy, we don't want to give up on that, and it's hard to.
Well, I hope we don't have the biggest collapse in history again to get those rates that low.
Right.
And honestly, that's what caused
you
our
didn't answer
inflation.
the question. What is the rate right now?
For what type of product? Are we going jumbo? Are we going FHA? Are we going conventional?
Conventional, yeah.
What type of credit score are we speaking about? So this is why we ask these questions, because it's like going to a doctor. Mm-hmm. Hey, I'm not feeling too well today. I'm sick. What's wrong with me? I got to run a blood test. because you are different than everybody.
What is
You
the
want an average?
average borrower? Like, for example, in 700s, paying 20% down payment, yeah, and
Today's market, you're running between 6 and 8, 6 and a quarter, depending upon how much it keeps running today.
6 and a quarter. So
And an
6 and a
FHA
quarter,
is running around 5.75 to 5.875 today.
and that's with the average credit score that can be done.
Yeah, with a 600, 620 credit score FHA, you're probably pulling around 575, 5.875. In today, this moment in time, 10:57 p.m. or a.m. on 10/7, October 7th. Yes, I'm trying to get down to the specific date and time because in 5 minutes it'll be different.
Right,
That's
right.
how much is changing. When the markets move, that's the part. Like, what does the rate matter to this moment in time? Because a lot of people try to predict what's going to rate to next week. Could anyone have predicted the rates raised almost 3/8 of a percentage point on one day? No. Could you have possibly? There's a lot of people saying the Fed's going to lower the rates 5 times again. We're not talking about the future. We're only talking about the current time being. If you have that crystal ball, if you have those 6 lotto numbers, please tell them to me. But I can watch millions of people talk on TV about stocks and bonds and everything else. Guess what? They're not multi-trillionaires. They're just taking their best educated guess. So it's about now. It's about them. But the rates right now, conventionally running the 6 and 8, 6 and a quarter, FHA running about 5.75 to 5.875. VA a tiny bit lower for our veterans, are probably running around 5.625, 5.5 right now. But rates come out at 11, which is in a couple minutes. We'll see really where the start of the day goes.
Great, thank you so much for all the information, and I have to do more of this. And so let's wrap up for today. And if you don't mind, can you provide your information where people could get you and how to contact you?
Absolutely. Nicholas Schmidtke, RCG Mortgage. That's spelled SCHMIDTKE. My phone number is 516-967-8643. And if you look up or Google Nicholas Schmidtke, you'll be able to find me all over the internet, YouTube, Facebook, Instagram, and even on Google. So anything you need from that aspect, by all means, reach out to me, and it'll be my pleasure to speak with you and give you the best knowledge I can. Mr. Hossein, thank you so much for having me. I
Thank you,
appreciate it.
Nicholas. Yeah, absolutely.
Thank you so much. Have a great day.
You too.